ladies and gents. Welcome to the inaugural episode of NGMI Trades. My name is TJ and I will be your host. This weekly show aims to give you a bite-sized recap of everything crypto, short and sharp. What we'll be looking at is a swift recap of the preceding week from both a crypto and broader markets perspective, predictions for the coming week. I'll then be showing you a few trade ideas, the reasoning behind them, and then I'll go ahead and put them on. Further to this, from time to time we'll be discussing farming strategies, where to make your money work hardest, the occasional moonshot, and then some NFT buzz from time to time as well. So, let's get cracking. First off, a quick intro for those who don't know me. My name is TJ. I have a traditional finance background. I spent 12 years on the bond market broking floor, screaming and shouting. Now, whilst it didn't do wonders for the old blood pressure, it did give me a good grounding and understanding in how the broader markets operate. I began investing in crypto in 2017. Watched the majority of my holdings get obliterated through 2018. I then spent 2019 and 2020 DCAing into a core portfolio of 4 coins: Bitcoin, Ethereum, Cardano, and Polkadot. There was no genius to it, no TA, no fundamentals, just a steady weekly purchase split across those 4 coins. In all honesty, a monkey with a keyboard could have made money during that period just by following a methodical DCA plan. Fast forward to the present day, and from a sentiment perspective, we are closer to the dark days of 2018 and 2019 than we are to the heady heights of 69k Bitcoin, where everyone felt amazing. And that is why I decided to start this channel. Bull markets feel good, bear markets make you rich. I'll say that again. Bull markets feel good, bull markets can feel really, really good, but bear markets make you rich. You've just got to stick around. So, being the first episode, I'm going to give a brief overview of my views on the market now and what I expect to come. So, let's start macro. This is how I view the wider environment. Layman's terms. It's bad, it gets a little better, it gets worse again, we then see real pain, and then the real green shoots start to emerge. So, inflation and interest rates, the buzzwords of the year so far. Rising inflation, rising interest rates are killers for risk markets. This is a US CPI chart, so US inflation, charting inflation from 2002 to the present day. As you can see, in 20 years, the prints we've seen this year are astronomical. The March print of 8.5% was, I believe, the highest in 40 years, and then the April print came in at 8.3. These are massive, massive numbers. So, what does it mean? What do we think? What's next? So, what I think is we are peak or close to the peak of inflation. The next couple of months, we see high prints, but then we begin to turn the corner. What does this mean? What this means is I think interest rates will not be raised as fast, as high, or as aggressively as others are predicting. What does this mean for the markets? Well, I think it means inflation risk has been priced in. Interest rate risk has been priced in. What has not been priced in yet is lower growth. So, short term, I have been banging on about this for weeks on my Twitter channel. Essentially, as of right now, crypto is very tightly correlated to equities. This chart is the Bitcoin price with the Nasdaq overlaid. So the Nasdaq is in orange, Bitcoin is in blue. And since really the beginning of this year, so if you come, so 1st of December, if you look at the correlation between the Nasdaq and Bitcoin, it's as strong as it's ever been. So to trade crypto, you have to understand how to trade equities. So what do I look at? DXY for starters, the dollar strength index. In times of uncertainty, money pours into DXY. So this is the DXY chart. Let me give it a that. This is the DXY chart, for the last 6 months. Now, as you can see, we've been on a massive run. Essentially, the dollar remains the safe haven for global money. So in times of uncertainty, money pours into it. Unfortunately, DXY strength is a killer for risk assets. So let's look at DXY and Bitcoin. So DXY in blue, Bitcoin in orange. As you can see from the run, as you can see from the run from the beginning of the year, this is actually from March, so March onwards this year, you can see DXY has gone from 96 up to a 105 high. When we tipped 105 on DXY, that was a 20-year high for dollar strength. It was massive. So the rejection was much needed for risk assets. Now, as you can see, as this has gone up, Bitcoin has sold off very aggressively. We reached the bottom here where we saw that capitulation event, which we have rebounded from and then have been treading water for a few weeks. Now, whereas DXY has been selling off, Bitcoin has actually not done a lot, whereas equity markets have seen a decent bounce. Now, this is very important to track what happens next. I think the rejection from that 20-year high, that 105 level, is reason for some optimism, for some green shoots. I said a few weeks back that if we saw a rejection and a continued sell-off, which we have, then I would start DCAing my Bitcoin position, which I began to do this week, and we'll come on to that. So, DXY, that should be a ticker on your list to keep an eye on. Next key indicator. We're going to look at the 10-year US bond yield. Bonds were my bread and butter for 12 years in TradFi, and I'll be honest, they are as boring as they sound. But they're very nuanced, and at this moment in time, a rather crude way to look at it, but a helpful way to look at it, is 10-year bond yield up, crypto price down. 10-year yield down, crypto price up. So without going into too much detail, essentially yield and price on bonds are inverted. So price up, yield down. Price up, yield down. They're inverted. Now this can be quite an abstract concept when you first hear it. But essentially what we need to know and what we're looking at and what we want to see is yield coming down. The 10-year yield coming down. Essentially what this indicates to the market, or what this indicates, the message the market is sending, I should say, is that the bond market has priced in interest rate risk. And this process has started. We hit a peak of 3.2, or maybe a tad under 3.2 in the first week of May. And since then, we have gradually started to turn a corner here. We're 1 month in, and the process has only just started. But if you come back and look at it on the yearly basis in terms of what bond yields have done, it's a big move. You know, this time last year, let's have a look. Where were we? So 1.6 up to a peak of 3.2 earlier this month. It's a massive move, but we are turning a corner, and that is another reason for optimism in the market. So that's DXY. That's 10-year bond yields. Now, without stating the obvious, we've also got to be looking at the US equity indexes. That's got to be on your ticker list if you're trading crypto at the moment. Now, at the beginning of the week, I said I thought this week we'd see a relief rally. What we've seen over the last month has been very aggressive and actually relatively unusual for the equity markets. So this is a longer term chart, 5 years or so. Let's have a look at the 1 year chart. So from the S&P 500 peak of circa 4.8, which was at the end of last year, beginning of this year, we've seen a massive retracement, and equities have bounced. So we found a bit of support last Friday, and then from Monday onwards this week, we've made a move, which is great to see, and it corresponds with this 10-year move, 10-year bond yield move, and importantly, that DXY sell-off that we were talking about. So that is the S&P 500. The bottom seems to be in, the short-term bottom seems to be in anyway, and this is what we've been talking about. So next, so far this has all been quite heavy on theory and the reasoning behind it. So let's get into what I picked up earlier in the week, what I'm looking to do with it, and what the next trade looks like, essentially. Very briefly, equities. I wanted to do this in real time, but unfortunately the microphone was playing up in my first take, so I have already closed the position. But I think this is important to show this because it makes you accountable. It shows you that you're acting on what you're talking about. So let's start with this. I picked up the S&P 500 in an ETF form, so an equity index exchange traded fund. It tracks the S&P 500, and it is my favorite exposure to the index. So the Vanguard S&P 500 ticker symbol is VUSA, V-U-S-A. So let's look at the details. I bought it on Tuesday, 8/18, 24th of May. I picked up contract cost £129,979. Units 2,196. Settlement price was £59.19. I then sold it earlier today on the 27th, which is a Friday, at lunchtime, 12:54. Settlement price £61.09 at £134,156. So call it £4,200 up. I think percentage terms are always important to look at, so we'll do that. Excuse me. So we go. So yeah, 3.2%. 3.2%, which, to be honest, looking at where the index is now, I jumped the gun a bit. I still have another 50,000, which I assume is now 51,500, something like that, running. But the sort of the major slice of that position has been taken off. I still have the same opinion. I think this is a relief rally, so I'm happy to book some profit, take the risk off the table. I have other long positions running, so yeah, I'm happy to book that. Next, I'd like to look at Tesla. So I picked up my favourite stock, Tesla, on Monday this week. So over two accounts. I don't like to keep all my risk in one basket, so I picked up 46 shares in this account for, after FX costs and transaction costs, it was £24,700. It's done well. It was an average entry of $666. So we'll do the percentage change on 752. So yeah, that's 12.9% uplift since the beginning of the week. So The beauty of trading crypto and equities next to each other, especially when they're like this, is that they are so closely correlated. But every so often you get an outlier like Tesla, which has exploded 12.9%, while Bitcoin has done very little this week. So anyway, sell for 46 shares, 752 will do that, except, so that's booking in circa 2.5 grand's profit. I have 44 shares on my other account, which I will look to close out after this video has ended. Now, let's look at Bitcoin. This is a very clean chart. Essentially, we've seen a period of chop since the capitulation event over the 11th, 12th, 13th of this month. Since then, we have come back into this range and traded very cleanly. It's been very choppy, so if you try to trade the range, you could have done. But for a lot of people, it's either just better to DCA or just to take a back seat and decide what you want to do. Now, personally, I have been waiting for a couple of these macro indicators to turn around. DXY, the 10-year bond yield, equities to find their floor, and then to see them rally off that level. Now, we've seen all three of those. So I promised myself I'd start DCAing into Bitcoin and a small amount into ETH. So what is interesting at the moment, and which is making me less strong on my conviction, I guess you could say, is that Bitcoin is not moving. It's not moving with this equity rally. All the macro indicators I wanted to see have moved, and equities have done what I expected them to do, but Bitcoin has not followed suit. So from that basis, my optimism for the trade is slightly tempered, but I promised I'd do it. So this week I have been DCAing this area. So where are we on this chart? So it is the 27th to the 22nd. So I have been buying here, all along this chart essentially. So entries as high as 30,300, entries as low as 28,800. I probably have an average of about 29.5k for my entries this week. I bought more Bitcoin this week than I have in months, and I've nibbled a little bit of ETH as well. But I mean, I would probably advise staying away from that trade for the moment, just for this reason, which I'm about to show you. So this chart is going to load up. Let's reload it. Essentially, the ETH Bitcoin relationship since May of last year has been trending one way. ETH has been outperforming Bitcoin. It has followed a very nice trend line, which has held, as I say, for the last 12 months. And to be honest, as an ETH investor, in the short term, you would want to see that hold. And when the chart loads, you're going to see that unfortunately it has not held. So let's go to the 1 week. And we'll zoom in a touch. Yeah, so that trend line, it's had a pretty disastrous week, actually disastrous last 2 or 3 days in particular. Now, long term, I'm absolutely convinced that if Ethereum will be the better long-term performer. I think it will outperform Bitcoin as an asset, but in the short term, that is worrying for me. So my focus this week has been investing into Bitcoin and then riding that into the weekend. I'm going to see how it plays out. I might take some risk off the table if we get the bounce into the weekly close, which I am still expecting. I wouldn't have the risk on otherwise. I'm still expecting a green candle into the close. It would be our first in 9 weeks. Otherwise, we are going to print another historic 9th red candle in a row, 9th weekly red candle in a row. Look, I've been wrong many times before. I'll be wrong again. but that is the trade I'm putting on. I'm happy to have booked some profit on my equity trades, and now I'm happy to roll the dice on this Bitcoin trade. For me, the macros line up, so I have to swing the bat at it. I will be keeping a very close eye on it, but yeah, that's where I am for the week. So, yeah, in summary, that's it really for this week. Do I think the worst is behind us? No, I don't. Do I think green shoots are appearing? Yes, I do. Do I think more pain is ahead? Yes, I do. I think booking profits on this relief rally is very sensible. So if we do see a green candle into the weekend, out of the weekend, I will be taking profits and then looking to continue to DCA my positions. At the end of the day, I am a long-term believer in this, and I fully believe that in 5-10 years' time, this will be the best performing asset class on the planet. Anyway, shorter term, remember, we think the market has priced in inflation. We think it has priced in interest rates, but I don't think it has priced in lower growth yet. And I think this will be the final leg down, and it will be a big leg down that will give real pain and real fear across almost all asset classes. So positioning for that will be key, and positioning for that will also enable you to make a lot of money. Also, at times like this, it's worth reminding yourself that through every crypto cycle, there are naysayers and doom merchants who say, this is the end. Filter out the noise, take a step back, and thank your lucky stars you have the opportunity to participate in something that is not only changing the world, it is our generation's gold rush. It is the chance to get rich in a fundamentally unfair, rigged and corrupt world. It may not happen this month, or this summer, or even this year. But if you're sensible, you keep some powder dry, and you DCA into this asset class, I still think it's an up-only bet on a 5 to 10 year horizon. Anyway, I hope you've all enjoyed this first episode. It's been great fun making it. And to mark the inaugural episode, I am doing a gutter pigeon clone giveaway. I'm a massive NFT fan, a massive gutter cat fan. I think, as you can see, I'm looking into the IP qualities of NFTs. I'm trying to brand this channel with my own gutter cat. I think it really is the beginning of the space. Utility, store value, online persona, flex, they have them all. And we'll be discussing that and other angles in future episodes. Anyway, to mark the first episode and stop me whittering on, a giveaway from my favourite NFT project, this boy. As per the tweet on my Twitter page, to get involved in the draw, all you have to do is subscribe to NGMI Trades, like the video, subscribe to my Twitter page, TJ_NGMI, and like the post. 4 things: tag 3 friends, and you're there. Winner to be announced in next week's episode. Guys, have a cracking weekend. Speak to you then.